Hi, everyone. We are back with our popular monthly roundtable. We are joined, I'm Mermi Desai, editor of MoveSmartly.com and host of the Move Smartly show. I'm here with my co-host, John Pasalis of Velocity Realty in Toronto. Hi, John.
Hello again.
And Steve Saretsky is our other panelist, our friend out in Vancouver with Oakland Realty. How are you, Steve?
Good. Yeah, lots to chat about today. It feels like never a dull moment.
Yeah. We're
Yeah,
on the Trump news cycle merry-go-round. What a ride. And I think it's quite obvious what day we're recording on today. We are starting to date our broadcast because news is changing so quickly. So we're all responding to the news that today, Tuesday, March 4th, Trump has imposed, I think it's fair to say, historic tariffs on Canada in violation of our free trade agreement with the United States of 25% across the board. So I'm wearing my colors, boys.
well
Elbows up,
done. I should
elbows up.
I should have my
Yeah, we're laughing, but these are grim times, and I think a lot of shock. I think the only reason we're able to laugh is Canadians saw this coming. The month reprieve that
Mhm.
Trump was giving us, no one quite bought into. I think we knew what he was all about. And I think our last show touched upon that. But before we return to that, I think we should start with our usual market updates because I'm thinking, guys, that massive global instability, not to mention one of the biggest threats to the Canadian economy that we've experienced in recent history, can't be good for our real estate markets, you think? So, Steve, I don't know, maybe we'll start with you in Vancouver. What are you seeing on the ground and what are you seeing in the data?
um yeah, I mean I think on the ground, I think it's just important to give people some context, right? We had a pretty strong Q4 of 2024. Obviously, rates were coming down, Bank of Canada was cutting, we knew more rate cuts were coming. So like the market was actually moving quite well. And so that kind of led to some optimism coming into 2025. Started off the year quite strong, and obviously the tariff stuff has just kind of derailed the market. Um, we've seen, the odd week here or there that has kind of seen like a bump in activity when it feels like the tariffs, got pulled back off. And so basically we're almost like the market's kind of just moving with this economic uncertainty. That's number one. What we're seeing in the data and on the market is inventory is building. Sales are they're weak. There's no question about it. Sales were down year over year, and it still continues to be a trend of product type. So we have a lot of divergences in the market. It is not a one size fits all market. What you're seeing is the weakness is particularly concentrated in the condo market, particularly around these investors. And the investors are really going to dictate, I think, the direction of the market this year, which is to say that in January for condos, we had a record number of new listings. In January, we had that again in February. So back-to-back months of record number of new listings coming to the market as we head into the spring selling season, which typically brings on even more listings. So there is a lot of selection there. Whereas the flip side, you look at the single family market and new listings were still, well below long-term averages. Inventory is still low. We're still seeing the entry level house go selling in a week or two, sometimes in multiple offers. So very different markets. I think we're seeing a lot of weakness as well in the suburbs, particularly in that condo market, which obviously had a huge run up during the pandemic. Tons of new building construction going on there, and a lot of investors that are just struggling and looking to get out. And so it's going to be very interesting.
Steve, can you tell us some of the names so we just get familiar with the Vancouver geography? So when you say the
Yeah.
suburbs where you're seeing these condos starting to sit, what markets are those?
Yeah. So when you look at if you go on BNN, Bloomberg, or whatever, they typically report on Greater Vancouver. So they say Greater Vancouver area, which is basically call any city within, let's say, 30 minutes of the core. As you push out, we call it, in the more of the suburbs, which is 45 minutes to an hour outside of the core. That tends to be called the Fraser Valley. And so the Fraser Valley is where you saw a lot of people move out of the city during the pandemic. So that'd be places like Surrey, where we've seen lots of immigration, Langley, Abbotsford. So again, more suburbs, it's more blue collar. So when you think about interest rates going up, who does that impact the most? It tends to be these types of people. And those markets saw the largest run up. So, in my opinion, they're obviously the most vulnerable to a correction. They're most vulnerable to tariffs, unemployment. And so I think that is sort of just building, and that's where we're seeing all the weakness right now.
Absolutely. I mean, I think the softwood lumber industry, which I raised it last on our last monthly, but now Trump has resurrected that ghost. So again, a lot of inter-country trade from that particular part of the country. So that's interesting. I guess, John, that's almost analogous. Not the GTA is affected in some of the outlying areas because of the manufacturing. But in Toronto, I think the equivalent would be that you go a bit further outside the GTA to see border communities like Windsor with the automotive plants so integrated with the United States. But also towns like Hamilton, which is adjacent to Toronto, being
Mhm.
really affected by the steel
Mhm.
uh, tariffs. So again, and then I think even in the GTA, we have the suburbs and the times that Steve mentioned, 30 minutes versus 45 minutes out. We have the suburbs that ring Toronto. Um, North of Toronto is York Region. I'm very familiar with that. John, I know your roots are there. And then we have towards the east, more of that manufacturing base, which we could see again downturn in the Durham region. The west end of Toronto, Mississauga would be very interesting. I am not sure how much Peel region is affected by our international trade. So that's something to keep an eye on. John, let's now turn over to you. What are you seeing in Toronto, in the GTA, in both what your clients are telling you on the ground and in the data?
Yeah, very similar dynamics to what Steve had touched on. Like we said, I think we chatted about in the last show that the sentiment in the fall was positive. Like the fall was like, the fall, I don't say the fall, the winter, Q4, the market rallied a little bit. People were rushing in to get ahead of what they thought was going to be a booming spring market, and obviously things are not booming right now. And the sentiment has shifted, right? Like we said, I mean, all of this uncertainty, and I'd say it's the uncertainty more than anything, not knowing what's going to happen, this sort of erratic behavior south of the border. It's very different from, 8 years ago when he won, where things felt more measured. There's more diplomacy, there's negotiations happening. This is just like, the president running around with a bloody hammer and just hitting whatever he wants. And you're not knowing if you're the next person that's going to get hit, right? And this isn't good for economies. It's not good for the housing market, and I think the clients we see, I think there is that anxiety. They're worried about what's going to happen to the economy. They're worried what's going to happen to home prices. Some are worried about their jobs, right? So there are grounds to be concerned. And, this is flowing through into a softer market. I mean, sales for houses in the GTA were down 29% over last year, which is a big decline because last year was also a soft year. Condo sales down 25%. Um, listings are pretty balanced for houses are kind of in line with the average historical volumes, but condos are like Steve said, condos in Toronto, new listings volumes are very high. Prices are somewhat stable, down like maybe 2-3%. But again, I think it's this sentiment shift that we're going to have to see how it plays out in the months ahead. Do people still feel anxious? Is there some more stability in the market? And I think all of that's going to ultimately dictate like what the next 6 months looks like.
So I have two follow-ups for you on this, the tariffs. Let's talk about that more specifically. One is the observation that when Trump kind of announced it a month ago, and then he's like, it's on pause, and I'm thinking about it. He's now announced it and introduced it. There is one school of thought that says, in a way, that's better for the
Mhm.
Canadian economy. It gives us a chance to start to understand what that means and adjust to it. not only businesses, obviously, is a huge impact. This isn't good news, but the devil you know is often better than the one that's very uncertain and holding all the cards.
Mhm.
So, I wonder what you think about that to start. Is it better that we now know the new normal going forward for a bit? And I mean, the strange thing about this man is he could literally rescind it tomorrow.
Mhm.
But let's presume that this is the new normal for the next 6 months or whatever it takes, or because and I say that because I think our prime minister, for all his faults, outgoing Prime Minister Trudeau, has mentioned, listen, we did the fentanyl thing, we did everything you asked. We are now there less fentanyl went over the last month,
Mhm.
from already less than 1%. So we don't know on what basis you're negotiating, right? And I
Yeah.
think that we can all agree on. But let's presume they stay in place
Mhm.
for at least 6 months. John, do you think that in a way that's better so Canadians can adjust to the new normal?
I mean, I think in theory it would be. And I do buy your argument that the bigger issue is just not knowing what the heck's going to happen and when. So having some clarity is a good thing. Now we can move on, put it behind us. The only reservation I have with that idea, though, is that things aren't normal. Like things are very escalated. Ontario's pulling every American bottle of alcohol off their shelves. Our premier's threatening to pull the plug on their electricity. So in theory, I think I'd buy that argument if it's like, okay, they introduce some tariffs, we introduce some tariffs, and we just move on and we call it a day, and this is the new normal. But it feels like it's not over. Like, everyone's just starting to buckle down and fight. And I think that's obviously going to create more tension because, like, if we start retaliating aggressively, which is a reasonable response, it's not like the Americans are just going to sit there and be like, okay,
In the
uh,
dark.
yeah, sure, cut off our electricity,
In
or
the dark with lots of Jim Bean.
or put in supply constraints the way China does on some of their energy and minerals. Like, you think the Americans just sit back and be like, no problem? The rhetoric is going to get elevated and escalated. And this lunatic's probably going to spin that into Canadians attacking the Americans, right? So you never know, man. It's such a volatile time.
I hate to say it, but it's like we're the new Ukraine.
Yeah, 100%.
Performance. Steve, you were prescient last month. You said this is a man who you've read his book. I didn't have time to because I
Ah,
don't know, got
we'll let
busy.
it slide. No.
But you did rightly say this is a vulture. This is somebody, right or wrong, whatever you believe, this is his MO. He circles for when partners are at a disadvantage and looks to grasp the spoils. And I think we saw that performance in the Oval Office against Zelensky uh, to a T. So you really called that. Now, my question to you is the same. Is it the uncertainty of his kind of behavior that makes Canadians pause more? Would it not be better for us to just know 25% tariffs? This is a huge hit. We're going to start having to look to Europe, look to Asia over the next 6 months. Like, what is your feeling on this?
Oh my gosh, I don't know. I mean, yeah, that's a tough one. There's a lot to digest there. I just think for, Canadians that are trying to make decisions here, I think it's just knowing that, like, you kind of have to keep your political views out of it and just try to look at it holistically and say this is just the world that we're in. It's a changing world order. I think, our friend of the show, Ben Rabideau, pointed out well today, which is like these 25% tariffs, like, let's be honest, they're probably not going to be on for probably that long, but there will be tariffs to some degree. So we'll probably get a better sense of what that looks like in the summer. So it might not be 25% across the board, but maybe it's 10% across the board on all these various different sectors, and those are permanent. And so that's still a difficult adjustment for, like, a lot of these sectors in Canada. I think the big thing around housing, right, is John, we've seen this over the last, 5, 10 years now, is like people hate making decisions, especially large financial decisions, in uncertain uncertainty and uncertain times. So it's like anytime you get these like policy shocks, the market basically just freezes. So we saw that with the foreign buyers tax. In particular, we saw it with like the mortgage stress test. We saw it with, the pandemic stuff. It's like anytime you have like economic uncertainty, policy shocks, people need to sort of wait and feel it out and digest it and see what happens. And so I think what's going to happen is the market here is going to freeze over the next couple months. People are going to sort of dip their toes back in the water, and then you'll get sales transacting again. I'm not saying you're getting, a snapback boom, but you'll get things transacting and things will start to move. But, it'll be interesting, John. I'm curious your thoughts, but like, we talked about when we saw like the big gap down in pricing in 2022, it's typically because people got caught between two transactions. So I'm wondering if there's maybe some element of that again today, where it's like, hey, listen, I bought a house in January, my condo's on the market here in March, and it's crickets. And I got a house to close on in April.
Yeah.
So it's not one of those ones where you just have to like hammer your price and let this thing go. Because
I
I
think
think, yeah,
I
yeah,
don't think that's happening as much, at least not in Toronto now, because I think anyone who needs to do two transactions sees that the market is insanely slow.
yeah,
And listen, unless they have the type of home, and there are homes in the Toronto area that you list it, it's beautiful, it's priced well, and they're going to get six offers. So unless you're that homeowner, most people are not buying first and then selling because especially if you have a condo, right?
yeah, that's a
Um,
good point. I mean, obviously the dynamics have changed significantly. I mean, obviously we give that advice to all our clients, sell first
yeah.
and then buy in this kind of environment. Obviously, at the end of the day, let's be honest, not everybody takes that advice.
Hmm.
Um, you can only give your advice and let people make their own decisions, right? And so I think yeah, to your point, you probably made a good rebuttal there, which is it probably won't be to the same extent, but I can think of a few people that I think will be caught in that.
You need to be cautious. Like we have clients and, I guess our advice is not like it's a function of the type of home they need to buy, the home they need to sell. Because for some of our
100%.
clients, buying first makes more sense because the type of home they want doesn't come up often, but they have a starter home that at least today would sell quickly,
Totally.
right?
And
And
they
it,
have and they've got lots of cash, lots of
yes,
liquidity where if they
exactly.
need to carry two homes temporarily for 3 to 6 months, they're really like hardly impacted.
Yeah.
But
So,
obviously, yeah, I mean that's a smaller portion of the market for
yeah,
sure.
exactly. Exactly.
All right, so I'm going to ask my second follow-up.
Sure.
So I take your point that Canadians don't like uncertainty, but they don't like the policy shocks.
Hmm.
But I've been digging through some numbers and I noticed a couple things. So after 9/11, it was one of the historic lowest rates that we've seen. It followed, right? So first a shock, oh my God.
Hmm.
And then because of the response to that is low interest rates, that's one number. We have the same reaction 2008, John, when you and I decided to launch philosophy. Interestingly enough, on the heels of we didn't foresee that I think we opened in March,
Hmm.
the American subprime mortgage collapse happened in the fall, and and we were told this is one of the biggest global financial crises. Like just get ready for your banks not to have money. Again, total standstill of the market. We experienced that again in the COVID era. I
Hmm.
remember quite vividly. John just saying the market's shut. We have to run a really intense online virtual conference with over 30 experts. Are me you in?
Hmm. We have to
Because
do
the
something.
market,
We're
yes,
bored. We have to pump out some content.
we have to pump out content because the market's dead. In all of these periods, my observation is that it was dead for a bit.
Hmm.
The low interest rates, so most of them hit in the territories of the threes in all these events, then led Canadians, once they could understand the new normal,
Hmm.
to go back to what they do, to go
Hmm.
back to what they love,
Hmm.
make the real estate moves, go back into real estate. And I asked this question whether this is still viable even now. Now, I do agree with John that I think if the Trump tariffs are volatile and moving and there's more uncertainty, but let's assume that we just have a new tariff environment. So we've taken a hit to our economy. I am wondering that whether once the Canadians get used to the new normal,
Mhm.
keeping in mind also that Canadians have more of their COVID era savings than the Americans have. The Americans seem to have run through, latest studies are showing. So it looks like some Canadians have been sitting on some cash waiting to make some moves. I would argue the third point. The minute they see prices go down,
Mhm.
and I think this is really crucial. It has to go down, whether it's the condo segment or in the freehold segment. Do Canadians not go back into their favorite game? It's not hockey. It's real
Hmm.
estate.
Do they
What
jump back in? What do you think, Steve?
was that like? Are you saying like this year,
If
Jeremy?
if prices dip, if
Yes.
prices
And not
dip
to
in
the
the
numbers we've seen, but do
yeah.
end users start making their moves? Do we start to see a return of some buyers to the market?
I think this comes down to like employ. I don't know. I feel like people, like the average person, when prices are falling, does the opposite of what they should do. Is they wait. They wait longer, and then they wait for prices to start rising again to basically give them the all clear. And when their neighbor starts buying, then they start buying. And so I don't know. So hard to predict where we'll be 12 months from now. I think at the end of the day, all I know quite confidently is the investor's not coming back this year. And so that's going to leave the condo market in a tough spot. It's going to leave the pre-sale market in a tough spot. Obviously, I'm looking at, I'm reading, BMO's note this morning here that just got updated. They're now calling for, 100 basis points of rate cuts, fixed rates coming down. I mean, you look at the Canada 5-year today, it's 2.5%. Haven't seen that in a long time. So, I mean, your fixed rates are going to be sub 4. Right. So, I don't know, maybe in 3 or 4 months, your 5-year fix is 3.5%. Does that get people off the sidelines? I think it does to some extent. And that's why I think you'll see transactions sort of bounce. But I mean, do they get back to their long-term averages this year? Probably not.
And Steve, the difference between, excuse me, the investors coming back the way they have, the differences in those previous areas that I mentioned, eras that I'm mentioning, is that home prices started from a lower base. We're now at the point where the Canadian average home price is just not enticing enough for these investors.
Yeah, like where prices are today, and then even if you assume that rates are, let's just call it 3.5, which is, 50, 60 basis points lower than today. I mean, the numbers are still not really going to work for the majority of this investment product. So the prices have to come down more, or rates have to come down more. It's a combination of the two. But I think it's also too, like, I just feel like people have been kind of scarred too, which is like, okay, I've seen what can happen. Maybe this isn't the best investment of all time. And so maybe I don't need to build a portfolio of rental condos, right? Whereas I feel like obviously during the boom years when prices are rising 10% a year, everybody wants to build like a condo portfolio and get rich. And I think we're seeing now is that cooler heads prevail, and that's just, the returns I think in that segment are going to be probably mediocre for the next few years.
Yeah, and I'd say I tend to agree with you. I mean, I think if we see a dip, the reality is you're 100% correct. In the short term, a decline in prices fuels negative sentiment. And yes, more people move to the sideline, hoping that in 3 months prices will be lower or expecting them to be lower. It's only like the really brave people who kind of jump in when prices are falling, right? But
And do your quote, do your Buffett quote.
oh yeah, what's the Buffett quote? Oh, be fearful. No, be greedy when others are fearful, and fearful when others are greedy. And there's a lot of truth to that. But
But
so
that's so like the housing market, John. Everybody loves real estate when they're in a bidding war.
exactly, it's true. It's true.
You
And
see
when
40 pairs of shoes at an open house, people go nuts. They love it.
yeah,
And then, when prices are down, that product can sit in the market for 4 months and you can negotiate the price by 100 grand. Nobody wants
okay,
to step up.
okay. I'm gonna go on a tangent just because I mean you just remind you're 100% correct. And sometimes even in normal markets, when the market in Toronto goes from tons of offers, bidding wars, 15, 10 offers. And then for some reason we hit a lull. And this often happens in like July or August, right?
Yeah.
Even in a normally good
It's
year.
called Canadian summer, John. That's the lull.
Exactly. So, and it kills me every time because the second the lull happens and you have these buyers who've been competing all spring and they're ready to bid on a house, and you're like, oh, great, this one's got no offers. Their first reaction is, what's wrong with it? What's going
That's
on?
it. Has literally gonna
What's the
say
problem?
what's wrong with it. Yeah.
What's wrong with it? Should we bid? What's the problem? Like, I know they have an inspection. Should we do our own? Like, what is happening? Like, this isn't normal. I don't want to bid. There's something going on, right? You know what I mean? And
I
everyone
don't mean to
freaks
laugh, John,
out.
but it's like the whole adage of like you see a restaurant and no one's in it.
No one's in it. Kind of.
You
Yes,
wanna go in there.
exactly. So anyhow, I mean that's a tangent, but yeah, I mean lower price. Like, listen, lower prices might fuel demand in the longer term, and I think it's a combination of lower prices and lower rates, like Steve said. But again, I think it's a long road. Like, I don't think we're gonna have a booming market in Toronto in 2025. Period. Like unless things change dramatically by the fourth quarter. I have a feeling it's going to be sluggish for most of this year, probably.
It's fair. That leads us to our next topic about so I mentioned this price drop, right?
Mm.
It looks like so far in Toronto and Vancouver, and I wonder what you think. The single family home, whether it's a detached semi row house, looks like the prices are still very, very sticky. And we've spoken about this, and the literature shows it. Prices, they rise quickly on the way up, but they're very slow to come down. And we've talked about sellers really holding out for the prices they want. But there's another segment, and the segment is the condo sector, specifically new construction. We've just seen, John and Steve, a lot of new reports. Credit to both of you for talking about how the pre-con sector has, to some point, been, let's just say, held up by the Canadian banks and larger industry that made the boom happen. John, you have a really great video that I'm going to just reattach in our show notes on this. And this idea of blanket appraisals being something that Canadian banks have been allowing for some of these new construction units. So quickly, you buy it for a certain price. 3 years later, when it's completed, it's not worth the same. But the banks go ahead and appraise it or bump up the valuation of the properties. And that's to presumably make sure that the buyers of these properties don't see a big loss that would prevent them from, quite frankly, being able to hang on to
Yeah.
and sell it on. So basically, we have spoken about how there is this nexus between Canadian banks, the building industry, and the pre-construction market. For the first time, I think was it last week, John, or this week, BMO came out, and is it the Bank of Montreal that led with this?
RBC is RBC.
RBC, sorry, Royal Bank, led by admitting that there had been this policy to do this, and more commentary indicating that their ability to keep doing this is not going to be strong. So, John, maybe from you, what does this mean? Are we going to see finally the first price drop in the pre-con or newly finished segment of the housing market?
So just to unpack this briefly, and I gotta give credit. I think, Steve, you were probably one of the first people I saw talking about this. I think it must have been close to a year ago, like maybe March or April of last year or May. I can't even remember. You started talking about it, and then of course most people in our industry, Ben, Ron, like a lot, obviously we all started hearing about this. And just to unpack what we're talking about at a high level, what Steve was talking about, what we've been talking about for a year, is if someone buys a pre-construction condo for $1 million, they put a 20% deposit, but they go to get their keys, and the bank says, "Well, wait a second, it's not worth $1 million. It's actually only worth 800 grand." Technically, that buyer would need to come up with another 20% of the new $800,000 price because their original 200 grand got wiped out. It's basically a capital call, right? Now, most investors don't have that extra money. So what banks were doing was basically saying, you know what, we're going to pretend it's not really worth 800. We're going to pretend it's worth what you paid for it, $1 million. Here's your $800,000 mortgage, call it a day. And so they basically would have 100% loan to value ratio, right? So this is what we're talking about with blanket appraisals. So Steve was talking about a year ago. I did a whole video on it. A lot of people in our industry were talking about it because it was like this open secret everybody knew. and no mainstream media wrote about it for a year until last month. It was in a Globe and Mail article where they got evidence where RBC was offering a buyer a blanket appraisal. And like, we're going to close our eyes. We're going to pretend it's worth it. So, listen, this is, I think, the important of YouTube, Twitter, these channels, all of this stuff. Like, to give Steve credit, to give everyone in our industry, where we talk about what's happening a year before it's in the freaking news, right? And again, we don't know how it's all going to play out, but this is what's been propping up the market. Now, to Ermie's point, how does it all play out? Since that article came out last month, many people I've talked to in the real estate industry are basically saying it's over. Like, the banks aren't going to do it. And partly why they're not going to do it is because the gap between what people paid and what their units are worth is too big. They paid 1,600 a square foot for a unit. That's only worth 1,100 a square foot. So they can't justify that. So I don't know to what extent that's true, but if banks aren't going to be doing that or doing it a lot less, yeah, we're going to potentially have some problems. Like, what happens is if too many people fail and they can't get a mortgage and they default, the project fails. And to be clear, this is why the banks were doing this. They weren't doing it because they cared about the mom and pop investors. Like, it's
Which is
not
why I
this.
think they'll keep doing it.
You think they'll keep doing it?
I think I think I don't think they have a choice. I mean, it's either if you're the construction lender on the project. So if RBC, for example, is the construction financier of the
Mhm.
development, and then they figure out that 30% of the building can't close because the values are too low and they come up with the capital, then you have 30% of the units that you have to reabsorb and try to sell. And then so it's basically like you're better off just to issue these 100% LTV mortgages, kick the can down the road 5 or 10 years, and manage the defaults on these borrowers, as opposed to having this massive development project.
But I think that's the problem. They're no longer 100% LTV mortgages. Like, they're worth so much less than what
Yeah,
people
I mean, I guess it depends on, yeah, and that's
project.
the, and
Yeah.
I've had these reporters that have reached out, in recent weeks asking about Vancouver, and I can tell you, like, we have issues in the pre-construction market. I don't think it's anywhere close to what the GTA is experiencing. So I don't think like the gap is necessarily like massive, but there's definitely, yeah, if you bought a unit in for example, a high rise in the Fraser Valley, which we talked about earlier, for, you bought a 2 bedroom for 800, like, yeah, decent chance it's actually worth 700 today. So there is a 100K shortfall. So if you're the lender, you just go blanket appraisal that, 100% LTV it, and kick the can down the road. I think that's manageable. Obviously, if it goes from 8 and it to 5, then you got a bigger problem.
And
But
that's the
I don't think,
Toronto problem. That's
yeah,
realistically the Toronto problem.
yeah. So that's probably the Toronto problem from what I hear and from what you're
Yeah.
telling me, John. From what I see in Vancouver, I think the pre-sale market is bad, but it isn't close to that bad.
People were paying 16, 1700 bucks a foot for like cookie cutter shitty condos. Like, not high end, beautiful, like just basic.
So we have a few of those in downtown Vancouver, like some of the high end, like fancy, like luxury buildings that they sold at the top of the market in 2017, 2018, that are now completing. Right? Think how many years that is, right? I mean, you pre-sold these things like 6 years ago, 7 years ago, and those ones sold out at like 2,800 bucks a foot. And it's like, well, what is the fair market value? Because those units are just such like a high-end luxury price point, and there's like no market for that. It's a lot of the foreign bid. Like, I would tell you this, like those ones sold out at 28. We're seeing the odd one resell now, and you're more like 2,000 a foot, which is still a huge number. But I mean, again, there's an $800 shortfall. We're seeing $1 million losses on some of these units that are actually closing and reselling. But that's a very tiny, tiny, tiny portion of the market, where it's almost like, what's the old adage? Like, if a tree falls in the forest and no one's around, does anyone hear it? Does it make a sound or whatever? And so what I'd say is, what I'm basically saying is, like, does anyone really care that some offshore investor lost $1 million. I would argue the average resale market does not notice that.
Mhm.
All right, this is where I'm putting my Dr. Evil now art of the deal fingers for our listeners together here. I'm in the market for a condo. John, are you saying, I don't know, Steve, if I can move to Vancouver for how much a square foot?
2,000.
2,800 a foot. For
Funny,
you, I can get it down to 2,700.
But art of the deal, John, are we going to see price drops in this segment before we move off this issue?
Listen, very possible. Listen, inventory's building up. It's a soft market. Like Steve said, the investor bid's going to be dead for a while. So if inventory piles up, we see pressure on prices. Yes. If a project fails, and this is one of the reasons why I think the banks have been propping it up, because the second one, new building, doesn't close and defaults, it changes the sentiment in the market, right? So very possible that we might see some pressure, especially smaller units. I think those are the more challenging ones. Like bigger units are kind of doing a little bit better, but very possible. I don't know, man. It's a coin toss.
John, am I gonna end up winning the bet at Veritas conference?
Oh yeah, you might actually. You're right. We played. You're right. You're right. We played. Me and Steve did a bear and bull debate, and me and David Larocque were on the bull side, and this is back in October. And you and Ron were on the bear side. And even though we won the debate, it's very possible you guys might end up being the correct
Yeah.
ones. So we'll
No,
see.
it's funny. So yeah,
Had Trump won by then? No, that was November.
well, the
Yeah.
organizer of the event said at the time in October, you had to pick a side and
Yeah.
you had to pitch your case. So it wasn't like, oh, he's bearish and I'm bullish. It was like, listen, let's make both arguments and let the audience decide. And John on the bull side won to suggest that prices at a minimum would be at least 1% higher 12 months later. And so we'll see. It's funny, right? I'm just pulling up our stat center here. So if you look at in Greater Vancouver, you look at the detached property market, you're up. So we're up 1.8% from last February.
Hmm.
So again, detached homes are actually up. And then you look at the condo segment where most of the weakness is, you were down 3%
Mhm.
On prices.
on prices from 12 months ago, which again, you look at it and say like, 3%, like I don't think that gets a whole lot of people
Actually,
excited.
shocking. When you square, I'll tell you this as a consumer, when you read all these headlines and then you see that, that is what's giving everyone pause. It doesn't make sense.
Yeah.
Everybody's waiting for when, one rung gives way. So what is a rung on the ladder? Like that's the question. So John, you're saying still probably not likely even in the GTA because of the nature of the micro units sold and
What's
involved.
what's probably not likely?
That it's the pre-construction condo rung that starts to really drop in prices. Not pre-construction. I want to say like
New
newly.
completions, yeah.
Yeah.
Potentially. And listen, in the resale
Because maybe the
market,
product is not that popular. Like what's coming onto the market.
yeah, it's the 500 square foot unit's not going
Yeah.
to be that popular.
And nobody wants it.
Not a
Uh,
lot of demand for
I
it.
just chime in here. So just to give people some context of like why talk about this investor bid a lot because it's been such a big portion of the market over the last 5+ years. And John's talked about this a lot, which is the sentiment side of it. And obviously, when prices are going up, everybody wants to build their portfolio of rental condos and be like a big landlord. And I just look at segments of the market like downtown Vancouver. You look at the downtown Vancouver condo market, which is where a lot of investors play. It's typically considered good real estate. Obviously, yes, it has its challenges, particularly through the pandemic, but it peaked in 2018, and so we're here in 2025, right? 7 years later, basically, and there's been like zero price growth. I think you're down about 7 or 8%, something like that over those 7 years. Now, if you adjust it for inflation in real terms, the median price of a condo in downtown Vancouver is down like 21%
Hmm.
over the last 7 years. So you look at some of these investors now that are like bought in 2018 or selling, they say, wow, I just lost, 22%. So you basically have like a decade of like no appreciation and just hasn't been a good investment at all. And so I just wonder if that translates into other segments of the market where, again, maybe you bought a condo in the suburbs in 2021, 2022, and you end up having to sit on this thing for 5 to 10 years and see no profit. I think is going to be a tough pill to swallow for a lot of people, and that will probably discourage them from becoming an investor again in the near future, which probably is a good thing for the health of our market long term. These things all tend to sort itself out over time.
Yeah, and I'd say that the challenge in Toronto too is I agree with you, very similar dynamics, but the new condo market was a full-on bubble. Okay, like there's no debate. Like you're not paying 1,600 a square foot for a pre-con unit when you can buy an existing one for 1,100 as a rational investor, right? It's like pure speculation. You don't have to put that much money down. You can phase it over 2 years. Like it's pure speculation. And this is why it's all falling apart now because it's all like driven by hot air and exuberance.
Mm-hmm.
And yeah, like and we haven't felt that. Like to Ermie's point, well, people are waiting. It doesn't seem normal. Yeah, because we haven't felt this burst yet. Like they're feeling it if you're a new condo builder and you're not selling anything, they're feeling it, but we haven't felt it as consumers yet.
Can I just chime in there? I'll
Yeah.
never forget, I'll never forget a story. So I had a friend of mine, and he worked for like a very large developer that was building all these towers. And he said to me, he's like, what do you think? I have a friends and family access here to like their pre-launch where like as an employee of the company, they're giving me access to basically go in and buy one of these pre-sale units. And I said, oh, okay, well, that's interesting. Like, what's the price? And I can't remember the exact numbers, but it was something like he was like, well, it's about, $1,300 a square foot. And I'm like, oh man, that's a lot of money. Like, the resale stuff that you guys just completed down the street, that's 1 year old. It's reselling at about 1,100 a foot. So like you're kind of betting on a lot of price appreciation over the next, let's say 3 or 4 years until completion. To go from 1,100 a foot to 1,300 a foot, you're really banking on this rising market. He goes, well, yeah, but look at, phase one. Phase one, we were launching that, 10 years ago at 700 a foot. And that ripped to 1,100 today. So why can't it get to 13? I was like, well, if you keep extrapolating higher, at some point you get these one bedrooms that are all $2,000 a foot in the next 8 years. And like, so it's just like people just kind of kept the
Yeah.
expectations in those pre-construction markets. Yeah, John, it was a bubble. Like the numbers didn't make sense. Developers, because it went on such a good run, that people just expected that it would continue. And it wasn't necessarily developers squeezing more juice in the profit. It was just like rising land prices. And through that, the cities started charging higher development charges. Everyone just thought they could just keep asking more and more and more.
Because the
And so
market was paying it, because
and the
buyers were
market was
paying it.
paying it. Yeah.
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 The real estate market itself has been responsible, I think, for two Nobel Prizes now. Schiller, Robert Schiller, and Daniel Kahneman.
Yeah.
This idea of just the way real estate anchors on what we got last time
Mhm.
Mhm.
and just moves from there. I mean, I think we may have overtaken Las Vegas gambling tables.
Yeah.
Right? Like we are the number one market where for some reason our common sense doesn't always stay at the table. But what I'm hearing from both of you is it's the investor segment that would need to return. So we'll see in the GTA, John. I mean, if nobody's holding these things up, we
Mhm.
would expect to see some of these failures. But then to Steve's point, how much are our banks invested in
Mhm.
keeping that market afloat? And the reason why I think this is like the canary in the coal mine segment is I think there are Canadians sitting on some savings. I think
Mhm.
overall Canadians are pretty prudent. I think they see the nonsense going on and are scared. But on the other hand, they're also looking for a price signal in real estate, and we just haven't seen a
Mhm.
shift
Mhm.
for all the negative headlines in such
Sure.
a long time. So
Yeah.
maybe that's a topic we can carry into next month. I think next month we'll also talk about the impact on the upcoming, looks like there'll be Canadian federal elections sooner rather than later, and what that will mean for our housing policies and our housing markets.
Mhm.
So join us next month. Thank you to John and Steve for your really insightful comments. And to all our viewers, thank you for listening and watching. Leave your comments on YouTube or send them in. We are on X Twitter at John Pazalis, at Steve Soretsky, and the show is at Move Smartly. Thank you all, and we'll see you next month.